Question of the day is, with Trump, trade wars, midterm election, tariffs, rising interest rates, what should you change in your portfolio? Getting that question a lot, and we're going to tackle that right after we take a look at these moose. So we got markets at an all-time high, close to it. We have an economy that's going to grow at 3 to 4% this year, 2018 expected. We have tax cuts that are putting money back in people's pockets. We have deregulation, which is making business easier. Now, regardless of your political beliefs, these have all been big boosters for the economy and the stock market. So the question is, why does it seem that they're doing everything they can to screw this up? We're at war with China in terms of trade wars. We're getting Canada mad, the EU mad. The idea of tariffs and a trade war are pretty scary when it comes to the economy. And then we got rising interest rates in a period of massive debt, and it sure doesn't seem like equity valuations are on the low end of valuations, which is scary. So what do you do? I'm getting lots of questions about this, so we need some practical tips to navigate what seems like treacherous waters. So the first tip with dealing with all of this craziness going on is to get some perspective. It's easy to lose perspective when you're watching news every day. You're hearing everything that's going on in the media. So one way to get perspective, one of my favorite ways, is to go for a walk or a hike, and I just happen to be in a great place to do that. My wife and I are in Rocky Mountain National Park, and we're on a about 3-mile hike. It's a great place to get perspective and remove yourself from all the craziness of the media messages. Say hi, honey.
Hi.
Oh, water. Some cold water. Water is the lifeblood of your body, right? Well, financially, cash is the lifeblood of your financial life. So I'm going to admit we are in a period of change. We are slowly increasing interest rates because the economy seems to be doing a lot better, which is a big shift from what we've seen over the last decade or so. And there's going to be winners and losers. And during times of change, one of the most important things you can do is have a lot of liquidity, a lot of water. That's going to allow you to adjust as winners and losers, and we get some visibility on what the new economy and interest rate environment is going to look like. A simple thing you can do right now, especially if you're within 5 years of retirement, is to check your cash reserves and make sure you have adequate cash reserves so your investment dollars are truly long-term. Now that sounds very simple, doesn't it? But in an environment where cash has been paying next to zero and market returns have been pretty nice, they've been pretty nice whether we're talking bonds, stocks, real estate, you name it, it's very easy to not have a lot of cash because it feels like it's unproductive. Now's the time to have a little bit of cash so you can be agile enough to adjust to this new change in the economy as interest rates hopefully normalize. So that's tip number 2. Make sure you're liquid. All right, we're back from our hike today. Went about 3.5 miles. And I want to talk to you about tip number 3, which is to have some logic behind how you make decisions. Now, the great investor Peter Lynch once said that more money has been lost in anticipating or making changes in order to avoid a correction or losing money short term than has ever really been lost in corrections themselves. And I think that's a really important thing to hold on to during times like this when it feels like everything is going crazy. You have to decide how you are making investment decisions. Now, myself, when I'm working with clients, we have a well thought out process that leads us to the strategy, that leads us to the tactics of how we are going to invest client assets to hopefully work towards the kind of life that they want. If you have a process that you put together to build your portfolio, now might be the time to go back and revisit that process, because that's a good anchor to help you make logical decisions rather than react to the shorter term things like trade wars and interest rate and rising environments and things like that that are transitory and really not part of the bigger picture. So tip number 3 is, if you have a well thought out process, go back and revisit it, because it might help you make more logical decisions. If you have a portfolio that you haven't really built using a well thought out process, maybe you should get one. All right, now tip number 4, we're going to get down to some practical things here. Now that we've taken a walk and gotten some perspective, we've made sure we had adequate liquidity on our balance sheet, so the long-term investments really are long-term. And we reviewed our process to understand how we built this portfolio in the first place. The next step is now to go review each of your investment portfolios from the viewpoint of the process you used to build them. So you probably targeted an asset allocation or a risk-reward profile that fit what you wanted to accomplish as a family. And in this big bull market, that may be totally out of whack, right? So now's the time to go maybe trim some gains and rebalance the portfolio so you're taking the amount of investment risk that you originally wanted to take. Now, remember, we had a video a couple weeks ago, and I'll put a link to it here, where we talked about how building a portfolio from an investment risk standpoint is very different as you're close to retirement. So you may want to go examine that to make sure that you're not building a portfolio based on some silly idea of risk tolerance. So that's your tip number 4. Get practical, use your process, and review the portfolio and make the rebalancing adjustments you need to make. You know, the reality is that most of us, including advisors, are pretty mediocre investors, because we build a process when it all makes sense, when everything is nice, and then when things get really good, we get a little bit too greedy, and when things get a little uncomfortable, whether it's trade wars or rising interest rates, we get a little fearful, and we end up making decisions that really don't serve what we're trying to accomplish as a family. Now, that's true on an individual basis, but advisors suffer with it as well, because we want to do well and respond to client worries and dreams. But study after study shows that the actual returns most investors get aren't even close to the investments they're investing in. And the big conclusion from that is because we're human. And when we're excited, we're buying because we're optimistic. And when we get a little worried, it feels like we need to take action to protect ourselves. So we sell, and then we fail to buy in before things go back up. The simple tips I gave you today are a little bit elementary. I get that. But you know what? You have a well thought out process and you follow it diligently, you're going to work towards rocking the kind of retirement that you want.